Happy Friday afternoon. Trying to give you some semblance of what in the world's going on. Talk about a disconnect between Main Street and Wall Street, right? Um, I'd encourage you to tune into my radio show tomorrow morning at 9 o'clock. You can do so by either going to the iHeartMedia app, or you can go to our website, careformywealth.com, and there's a spot on there where you can listen live. Anyway, tomorrow I'm going to just expand on some of the things I'm going to quickly touch on here today to give you some semblance of what I think is happening. And what is happening? Well, the list of firsts, in other words, the list of wow, that's never happened before in the history of markets is getting longer and longer. And that's odd, of course. As you know, we've taken a very defensive position throughout this entire cycle for a number of reasons. One, depression level unemployment is a thing. It is real. It has a number of second derivative knockoff effects that do affect how markets perform and work. Not to mention the kinds of companies that will or won't be in existence after all the dust settles. The Fed and the liquidity that they're driving, which there's some misconceptions about how the Fed is doing that and that sort of stuff. So some of the things that we're seeing going from depression to recession to recovery to euphoria, essentially in less than 100 days is, well, it's unprecedented. So nevertheless, one of the things that we always attempt to do is invest in a bucket of assets, whatever asset class has the best regime in terms of price volume volatility, and then allow our algorithms to work through the market and work through the process to identify what has the likelihood of the best momentum with the least amount of volatility. Makes sense? And so the price volume volatility modeling that we use sometimes is misunderstood because what I'm coming at it from is from a full cycle investment perspective. I'm not chasing charts. I'm not running after stocks or various forms of equity-based ETFs. I'm not waiting for the Fed to bail out whatever next bad decision the junk bond market may or may not make. We're simply attempting to try and get the phase transition from one economic structure to another economic structure correct. And if we do that, then that'll allow us to identify the best asset classes that work within those economic phase changes. That then gives us the ability and the opportunity to make sure that we're shifting specifically and accordingly to what those phase changes are. So where do I think we are currently? I think we're currently moving from a deflationary cycle, which clearly was in place, slowing growth, slowing inflation. And now the market's starting to front run the next economic phase change. And we're seeing it in the relationship in terms of what's happened recently with the dollar, which is why we sold our dollar position. It broke trend. When something breaks trend, it breaks a rule. And so we're very rules-based. When a rule is broken, then the next thing happens. And in this instance, when the dollar broke a trend, it was time to move on. It was time to change and move out. And I think ultimately that'll be a fine decision. Could we come back and potentially work into a dollar position again? Sure, of course. However, as I said, there are certain assets that work well within a current economic cycle, and there are others that don't. So I think the market's front running into a stagflation environment, meaning slow growth and increasing inflation. Some of you who are old enough to remember what investing in the 1970s was like will know that stagflation is not a good thing, at least for equities. It is a good thing for certain pockets of equities, dependent upon whether or not the volatility regime calms down, and we've started to see that. So the number of things that have been happening this week that really stand out to us is, number one, bond volatility as identified by what's called the MOVE index, MOVE, was getting out of control, and it really spiked on Thursday and Friday today. The Fed hates it when the MOVE index gets out of control because that allows the Treasury market to get out of control. When that gets out of control, then everything starts to get out of control, including and very specifically equities. So the Fed overnight, Thursday into Friday, engaged in a $109 billion operation in the repo market to try and basically quell some of that MOVE index volatility that was eking into the market. Gold volatility is still extremely low and very investable. Treasury market volatility is low, but it was rising, and that's why we saw interest rates spike over the last week. And I'm going to share my screen with you so I can show you the extent to which interest rates did spike and why we saw some of the prices of our longer dated long-term treasuries get hit a little bit here. But interest rates from Monday to today rose from close to close a grand total of 36.5%. Now, in any normal market, a 36% rise or drop in 1 week is a lot. Same thing is true for the Treasury market. So what's ordinarily a very, very calm, fairly orderly market, as you can see from that chart, there have been some times this year where it's been very disorderly. We're in that instance where this week we had some disorder come in, but we also know that disorder is typically met with some Fed action to help calm that down, and we certainly anticipate that'll be the same instance here as well. We're watching treasuries very, very carefully, but in an environment, economically speaking, where stagflation is the rule of the day, long-dated treasuries typically do fine. Treasury inflation protected securities do really well. So we started a position in TIPS, right? Gold can do fine. Municipal bonds can do fine. And then there are some assets within the equity market that can do well also. So the question becomes, is the volatility regime in equities changed enough for us to believe that the market will start to stabilize and hold? Now, I know that this sounds amazingly ridiculous when I say that the volatility regime will maintain and hold to make equities investable, presuming and considering what has happened since March 23rd. Obviously, the equity market has gone up way more than I had anticipated, and far more than reality of any fundamental could deem reasonable. The market is, by every measure, overpriced and overbought. Euphoria is clearly eking into the market. Now, that doesn't mean the market's going to keep going up, and it doesn't mean it's going to have an immediate drop. What it says is that the probabilities are continuing to grow, that the more that this market goes up, we experience another crash. And that's going to be identified more likely than not by whether or not volatility starts creeping back in again. So let me show you a picture of equity volatility real quick, and you can get a glimpse into what I mean by that. So equity volatility has come down a substantial amount, closed today at roughly 24. Trend for the volatility indicator was roughly 25. So what does that mean? That means basically that this shift in momentum, the change in sentiment for the market is potentially very, very real. Now, it's still elevated. I mean, the investable bucket that typically exists in a normal, fairly strong bull market is typically down in the mid-teens and fairly quiet. The VIX has not been quiet, as you can see. Volatility. Small cap volatility, which is identified by RVX, is also very out of kilter. And as you can see, it's pretty high. And it came down and then started back up. So are we going to see an increase in volatility in equities over the next week? It's highly possible. And if that happens, of course, we probably would anticipate stock prices to come down a little bit. So here's what we're seeing. We're seeing a change in trend in the S&P 500 from bearish to bullish. Why now? Why this late? Some of you might be thinking. It all has to do with volatility. Volatility has calmed down to the extent that the shift in trend has allowed it to shift bullish from bearish. And that's true for the S&P, that's true for the NASDAQ. That is not true for small caps. Fundamentally speaking, small caps are still a train wreck. There are a number of companies within the Russell 2000 that are penniless. They have no money and they have no earnings. Most companies within the Russell 2000 are experiencing a 97% year-over-year earnings decline. Now, I don't know about you, but if you owned a business and your earnings dropped almost 100%, that's bad. That would put you in a pickle. And I think there are a lot of companies in the Russell 2000 that exactly are in that situation. A number of financials are in the Russell 2000, and in an economic quadrant of stagflation, one of the number one short positions to have on, in other words, anticipation for that position to drop, are financials. So the second best one, of course, is going to be the Russell 2000 because there are so many financials in the Russell 2000. So, at any rate, we're in a situation where we're just going through some volatility in the Treasury market. I believe that that's going to calm down because the Fed can't have Treasury market volatility to the extent of what we've been seeing in the MOVE index. Gold volatility is very normal. Pulled back a little bit today. I think it's going to be fine here over the next week, especially as we see what appears to be a worldwide currency devaluation. We're seeing it in the yen. We're seeing it in the pound. We're seeing it in the franc. We're seeing it in a number of major currencies. The euro has had a huge spike, which is very interesting. So the FX market is usually fairly quiet. It's not right now. The bond market is usually fairly quiet. It's not right now. And no matter what someone does, it seems that the only thing that can happen in the world of equities is that they go up. There is lots of rampant speculation in the market. When I say the market, in this case, I mean the stock market. And how do I know that? Well, here's an example. So let's look at a company by the name of Hertz. I'm sure most of you have heard of Hertz Global Holdings, which is the company that rents all the cars. As you know, they declared bankruptcy, and that bankruptcy kicked in, I believe it was this day on Tuesday the 26th. So interestingly enough, from Tuesday the 26th through today's close, Hertz stock is up 482%. Last time I checked, most reasonable people would remember that in bankruptcy, most equity holders get wiped out. This tells me that there are a lot of very new investors entering into the market, and that's true when you start to track some things from a group called Robinhood, which is kind of the new stock traders place for new investors sort of thing. And they're investing in a lot of stuff that have no earnings and no sales and just are playing momentum, playing volatility. That's not what we do. We're looking at full cycle investing, working on full economic structuring. And you have to remember, we're coming at this from the perspective that our portfolios, your money have been risk managed through this cycle where we're still above where we were on the February 19th highs. So even though we've been very, very defensive, and even though today, the last 2 days, with interest rates spiking and gold dropping a little bit, it's hurt our portfolios, it's nowhere near the extent to which most people are having to contend. We have to remember, the S&P 500 is still down from its highs by 5-6%. The Russell 2000 is still down roughly 10% from its highs. And these are important things to remember and consider. But at the same time, I understand how it feels to not be part of a market that just doesn't seem like it can go down, that you're missing out, that there's so many opportunities that could have been had. I get it. I've said 100 million times, if I've said it once, that if in fact we were to get a new, true blue, real solidified bull market confirmed, not only by fundamentals, but a shift in the economic cycle and technicals, that there'll be a lot of room. There'll be a lot of growth to get. So something that has happened this past week, first time in the history of the world, is an analysis that we do where we're tracking volume on New York Stock Exchange stocks and we're tracking gainers and decliners. And so typically if the volume is going into all the stocks going up and it exceeds 80 or 90%, we call that a very, very strong technical buy signal from an institutional perspective. Through this whole cycle, we've had a number of big institutional 80% plus upside days and big institutional 80 to 90% downside days, washing out any good that might have come through that process. We usually only see a back-to-back 80% upside day analysis in the midst of some of the strongest moves, right? Let me share this with you because I do think that this is an interesting cycle. And let me do this. So this is a picture of one of my spreadsheets, and it's broken down over the past 7 trading days, essentially, 8 trading days. And at any rate, you can see that these were 84 and 83% upside days, 81, 80, 86. There has never been a time in the history of the world where we've had back-to-back 80s, not only once, but twice, followed up with an additional 86%. And then we had something called breakaway momentum occur right here, which is brand new. Breakaway momentum is a very rare technical indicator that is a 10-day moving average of net advancers on the New York Stock Exchange. The last time we got that was January 9th, 2018. And you might remember that was kind of the beginning stages of a fairly strong run in equities as a whole. And so therefore, this is a very strong signal, and I don't want to ignore it. Even though there have been instances in history where it didn't work, the 30s were an instance where breakaway momentum and upside downside analysis did not work. The only comparison I can give you in terms of where we are today with depression level unemployment is the 30s. So is it possible that that particular technical indicator won't work? Yeah, it's possible. We have a cyclically adjusted PE ratio consistent with the same level that existed in 1929. Now, is that to suggest we're going to get a 1929 crash? No. But when you have cyclically adjusted valuations on equities at nosebleed levels like they are now, and depression level unemployment, which clearly affects consumers' spending capability in a consumer-driven economy, those have second derivative knockoff effects. And I would be remiss to think that it's just all puppies and rainbows from here on out. I think that there's a very large possibility that we could in fact see an additional crash in 2020. But you play the game you've got in front of you, not the one behind you, right? And so the game we've got in front of us right now are S&P 500 and NASDAQ both signaling bullish trend. Interest rates, both on the 10-year and the 2-year Treasury, both signaling bearish trend. And what that means is that if interest rates come down, that's the trend, the prices of our Treasuries will go up. And that's what we anticipate. Same thing with gold. Gold is in a bullish trend. Dollar's a bearish trend, so we sold it. The equities that work inside of a stagflation environment are things like utilities, technology, energy, REITs, real estate investment trusts, names with quality, growth, low beta. Beta just means is it less risky than the market. And so all these things are coming together, right? I would be very cautious on REITs, real estate investment trusts, and I'd be cautious of energy only because both of those still have a volatility regime that's very high. And REITs, of course, own a number of commercial real estate properties, and with the whole new work from home scenario that's played out, a number of companies have in fact said, we're done with our corporate offices. We're going to allow our employees to be more flexible and work from home. So I'm going to show you a quick picture that includes an analysis of what those types of investments that do well within a stagflation environment. And this is back tested for a long way. Algorithmic driven, and so you can see utilities, tech, energy, REITs, secular growers, low beta, quality, and growth are what do well. So those would be our net longs. For those of you that have an account where we only go ownership of something and not selling short on something, it'd be that sort of stuff. Retirement accounts, things of that nature, and of course on the fixed income side, it'd be long-dated treasuries like we already own. Treasury inflation protected securities like we own, and some investment grade bonds. We owned those, but we sold those out because they were showing intermediate term overbought. Eventually, energy could be a purchase. We would not use USO because the structure of that has actually changed fairly significantly from what we like to see on how an ETF should and could be structured. So the short side of things, the two best things to continue to anticipate to go down would be small caps and financials. They've gone against us, and that certainly points towards some of the poorer return here in the near term that we've got. But I think all in all, things are going to be fine. We're still fine. We're ahead of the game. We're in the green, and we'll be okay, right? As a whole, when you consider investing from the full cycle perspective of having been here within that February timeline through now, we're still ahead. So we're okay. And I would anticipate things will continue to move in the right direction in that regard. The other couple things that I want to point out to you with regards to my slides here is a picture of interest rates comparative to the equity market as a whole. And so this line with the black and the red in it is the S&P 500. This line down here is 10-year yields. And you can see 10-year yields have started to move up, but the equity market's moved up more. And so there's this gap between these two. And the last time we had a gap that really started to get created was, again, back in February, and then that gap got slammed shut. Ordinarily, it slams shut dependent upon one of two things. Either the S&P comes down or interest rates go up. Some would look at what's happened to interest rates in the last 2 days and say, clearly interest rates are going to go up. Yeah, maybe, but I wouldn't necessarily bet on that at this point. The Fed has got to be very, very careful about, again, too much volatility moving into that MOVE index that I talked about. So we need to be concerned in that respect that interest rates might in fact start to move up, but I don't anticipate that'll be the case. The last thing I want to show you is the Citi Economic Surprise Index. Never seen anything like that before. So as I've commented, the list of, well, that's never happened in the history of markets before continues to grow and expand. The Economic Surprise Index is exactly that. Now, let me say this last thing as it relates to unemployment, because it does have a very serious impact on the economy and where we're at. The number was reported as 13.3% unemployed. A year ago, it was 4%, right? The real number, based on if you read through the Bureau of Labor Statistics data, is 16.3%, not 13.3%. But regardless, last time I checked, 13% unemployment is a ginormous number. What happens when the additional unemployment insurance payments run out in July? What happens when the PPP is essentially paid for, right, or used up? If you do the math on average earnings of workers in the U.S., and if you look at what the average pay the PPP provided, the Payment Protection Plan provided for those employees that were kept on the payroll with employers, and you divide that by the amount of money provided through the Payment Protection Plan, the number is roughly 22 million jobs. So the growth that people were getting all excited about yesterday in jobs numbers, I don't know that I can quantify that as recovery. It's PPP driven. And the question becomes, are they going to do that again? Is that just something that they're going to continue to throw money at? Are they going to print money until the end of time? I don't know the answer to those questions. All I do know is that the economic cycle appears to be moving into a stagflationary event. When stagflation takes place, there are certain equities and certain bonds that are better places to be. We will make those shifts as we continue to get confirmation. As it stands right now, because the S&P and the NASDAQ flipped bullish on the backs of a historical event in technical readings, when we get down days, I'll start to very, very slowly eke into only those equity positions that have back tested to work algorithmically within this kind of an environment. So that's that. I'm way too long, but this is a weird environment, and it is really hard to explain inside of just 10 minutes and try to help you understand where things are at. If you have any questions at all, please reach out to me and let me know. I really enjoy hearing from you. I do want to answer your questions as best as I can. These kinds of environments generate a lot of activity. And as you can see, what we were doing were booking gains when we had the opportunity and then taking some off the books when it was time. And so going back into a particular asset class and then coming out. And we do that because things can move very, very quickly sometimes. So that's not a normal environment. Ordinarily, we buy something and hold on to it for a fairly long period. But deflationary environments, stagflationary environments, they're a whole different breed, right? There's not a lot of people investing today that have had to trade manage through that kind of stuff. So we'll keep risk managing the process and the market in your portfolio. Again, if you have any questions, reach out to me directly. My line that is direct is 608-354-1977. You can also text on that line or send me an email, chris@careformywealth.com. Hope you have an amazing weekend. Hope you enjoy whatever you might be doing for fun. Get out, enjoy the weather. I hope to do that too. My son has a baseball game tomorrow. Yay. All right. Have a great night, guys. Take care.